Let's talk Harami and engulfing candlestick patterns. They're similar, but yet slightly different too, of course, as well. And let's start with the Harami. And Harami actually means pregnant in Japanese. And you can, if you look over on that samples I have there on the left there, you can kind of see where you have a small real body comes after a bigger body before it. Here we have a long red candle, and then we have a short real body in terms after it. So you can almost imagine it's like somebody might be pregnant or whatever. And that's the idea behind a Harami, is that you have the small body coming after a big bodied candle. And you want to look at the color of the candle makeup. It's green followed by red would be a bearish type sign, and red followed by green would be more of a bullish sign. So in our example here, you can see that we have a red candle, and then that is followed by a green one. So this would be a bullish one. And you can kind of guess at that because you can see there's going to be an upward trend following afterward. And what a Harami is really telling you is it's an indication that a change in sentiment is coming. Something's coming. So if you're looking for an indicator that say, hey, there might be a reversal or some change coming here, Haramis can be very helpful for that. And the smaller the real body on the second Harami, the more powerful indication that the reversal is coming. If it's not much difference between the two, then it's not really a Harami. You're looking for a taller or longer real body candle followed by a shorter kind of squat, small, distance one followed by after it. And you're looking at the real bodies of these candles a little more so than, let's say, the wicks going up or down. But that's where you're looking at these open and closes around the candle. So if you're looking at this Harami, you'd say, okay, we can see we've been in a definite downward trend, or we've got a couple, basically 3 red candlesticks in a row. Boom, all of a sudden, this narrow trading range, but the opening is low and the close is higher, so it changes the candle color to green. That it's now a higher open, or excuse me, a higher close than the open after we've been, in a downward trend, signaling that a trend change might be coming. Now, as we know with trends, we want to make sure we let the trend develop. We could see this and say, it's definitely Harami, and it turns out to be a false signal. It's not Harami at all. So once we see that second day and certainly that third day, now we're starting to see more of a confirmation that a real trend reversal has occurred, and that now we can be trading off of that. How soon you get in, you might be a little bit more related to your risk and and how you want to judge that, and be whether you want to be quick on Harami or whether you want to let that form more and be a little bit more confident. But either way, you're looking at a real body, a bigger one followed by a small one. Just look at the which one's preceding which to see whether that's a bearish signal or a bullish signal. Like the Harami, engulfing candlesticks also will signal a reversal of a trend. So you're looking at trends and you're seeing if it's going to continue or be changed or reversed. And that's where engulfing candlesticks work just like Haramis. But it's if you look at the images on the left here, you can see what's highlighted in the square. It's kind of the opposite, right? You don't have that pregnant type look. You have the opposite, where you have something that's shorter and smaller being engulfed by something that's bigger. And that's the key thing. You have to wait for that second bar, in the example in the box here, to occur. You can't just guess, oh, well, we have, let's say, an upward trend, and all of a sudden we got a shorter real body and say, oh, we're definitely going to have a reversal. That could not be true at all. It could be just a little it's just a matter of a trading day, and in terms of open and closes, and the trends is going to continue. They usually don't look this, clean and neat. You're looking for something that's going to engulf it. And that's really what's happening, is there's a wider range of the opening and closing than the day before. And if you can look at either of the examples, you can see that the second day in the box is bigger or wider or basically taller, and it's going to completely engulf. And that's the key thing. It's going to completely cover or engulf the opening and closing of the day before. And if you have a higher opening and a lower close in this engulfing candlestick, that's a bearish sign. Prices are going to start headed down. And if you have a lower open but a higher close, then that's a bullish signal, and then prices will start rising. And in both ways, you're looking at the previous, what's happening before, to see if there's an established trend, because this is all about trend reversals. It really works when there's a trend, not so much when there's no trend yet at all. So if we look at that example up in the top with the bearish engulfing, we've got a nice strong trend. We've got higher highs going on there. Even that small little short one there of that candlestick is still a little bit higher than the high day before as far as the close. And so everything's going green, everything's going up. And then all of a sudden what happens, you have this big engulfing candlestick. So you see that engulfs it. You have this big red thing where the opening is opening higher than the day before, but then the close is going to go lower than the close the day before, and that's why it's a red candlestick. And so that's telling there's a lot of downward selling pressure. And that's where you need to wait for the next one to just confirm it. This will look like it, and some people, you can trade right on that and say, oh, that looks real bearish to me, I'm just going to do it. And that's okay, you're taking more risk that way, and you have a bigger chance for being wrong or a false signal. But you can certainly do that as far as your own risk and reward pattern around that. But if I look at, let's say, now the second red candlestick that's coming outside the box on this bearish engulfing, I can see, okay, now I'm seeing lower lows, and so now I think we've got a true bearish engulfing pattern here, and then I can, if I own the security, I would sell it. I would sell at some point here to get out because I've already made my profits on that nice trend going up, and now I want to take my profits. Now, if I look at the bullish engulfing, maybe this is a security we're not in because it's going down in price. We have a definite downward trend with all those red candles down there. And then we have the similar thing, just the opposite. We have a lower low, a short body in the red, that's then engulfed by this nice big green candlestick, the real body of the candlestick. And so we have our closing is that's higher than the open and close of the red candlestick. And, everything's being engulfed in there. We wait for the next candlestick outside the box to kind of give us some confirming, waiting for that second bar to happen, and that price bar. And we can see, yeah, this is a trend reversal. Look, we're going upwards now. So this, when you start seeing things like engulfing candlesticks, think, is a trend being reversed? Is there a trend, and is the trend being reversed? And wait for it to happen. The longer you wait for it, you're going to lose a little bit of opportunity cost where maybe you could have gotten a little earlier, but you're going to have less losses as far as being wrong or a false signal. It's really good to let these engulfing candlesticks kind of truly, form a little bit and have that second bar, the one outside the box, so basically, and to kind of both bars basically, the engulfing one and the one after can be really good confirming patterns with engulfing candlesticks, and they work just like Harami's, where you're looking at trend reversals.